Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So before we get into the topic of today's video, I just want to mention that I was recently on a podcast with Brandon, who you will all know from the Aussie Wealth Creation YouTube channel, and Hamish Hodder from the Hamish Hodder YouTube channel. I was on their podcast, the Young Investors podcast. We talked for about an hour around a bunch of stuff that's happening in the world at the moment with investing and getting into some more detail with some of the stocks I've been looking into and how I kind of go about my particular investment process. So I'll leave a link down in the description to the YouTube version of the podcast if you're interested in checking that out. But you can also look up the Young Investors podcast on Spotify or Apple Podcasts as well. So feel free to check that out and let me know what you think. But with all that said, let's get into the topic of today's video. So today's video is sort of summarizing a paper that recently came out of a US investment company called AQR, and this article was put together by Cliff Asness and his team. Now AQR are basically quantitative value investors in terms of the way they go about their investing approach in the stock market, and I'll get into what that actually means in a sec, but essentially what they found is that right now there is a massive spread, a massive gap between the cheapest stocks in the market on various metrics, so price to book, price to earnings, a few different kind of metrics there. There is a massive spread between the cheapest stocks in the market and the most expensive stocks in the market on those metrics. And they're basically, it's as wide a spread as it has almost ever been, and the only real comparable period to that is the late 90s and the early 2000s with the dot-com boom and subsequent bust. And I really want to get into what this actually means and the reason why it is potentially a good thing for more kind of value-oriented investors as well. So let's get into it, and also let me know what you think of this article as well. Keen to hear your thoughts on it. So first, let me just talk through what systematic or quantitative value investing kind of is, and how that kind of relates to the way I go about things personally. So quantitative value investing is sort of old school Warren Buffett, Ben Graham style investing. It's when you go through and look at very sort of strict statistical measures of how cheap or how expensive a particular company is, and really making the vast majority of your decisions based purely on those metrics. So you're not really getting in under the covers of what is likely to happen with the business in the future in terms of growth prospects and so on. You might just be buying, the cheapest price to earning stocks or price to book value stocks or price to free cash flow stocks that you can basically find, getting together a basket of them, and traditionally that has performed very, very well over basically the past century. So that's sort of the way that quantitative value investors go about their investing, and they've had a pretty rough last kind of 10 or 15 years. It's basically the longest stretch ever where those cheap value stocks have not outperformed the high-flying growth stocks. It's actually been the other way around. Now, the other camp of value investors, and the one that I tend to fall into, is more of the modern Warren Buffett style investor, where we're really trying to figure out what the intrinsic value of a business is, and the way we're doing that is more of a discounted cash flow style approach. So we're looking at, if I buy this business today, how much cash is that business likely to produce now and in the future, and what's a reasonable price to pay for that? So if over the lifetime of holding a business, I'm going to get on average maybe $10,000 a year, maybe I'd be willing to pay $90,000 or $100,000 a year for that cash to be returned to me. But I'm not going to go out and pay millions of dollars because it just doesn't make sense based on the cash that is going to come back to me. So that's the type of mindset and thinking that each of those two camps kind of fit into. And that's a bit of a background on the sort of two styles of value investing we're talking about here. So this article specifically really relates to the statistical value, find the cheapest stuff you can on certain metrics, and why it hasn't worked very well recently, and why it may be potentially set up to work very, very well over the next few years. So I'm going to put a few graphs and tables and things up on the screen here just to show you some of the results coming out of this AQR paper. Basically what they found is that with the price to book ratio, the price to trailing earnings, so that's last year's earnings, and the price to forward earnings ratio, so that's a forecast of what companies are likely to earn over the next 12 months, all three of those ratios, we are in the 100th percentile in terms of the spread between the cheapest stocks and the most expensive stocks on each of those metrics. So we all know that certain companies deserve higher PE ratios or lower PE ratios, or higher price to book or lower price to book, and all those sorts of things based on what the business is actually doing. But nonetheless, it's interesting to see that the spread is just insanely wide. And I'll put up a couple of graphs that kind of relate to this, that show that we've really never been at these levels. We were in and around them in 2007, 2008, and we were up around that for actually a couple of years in 99 and 2000. But really, we've never been able to sustain this wider spread for a long, long period of time. It's only ever lasted 6 months or a year or 2 years, and then some dramatic things have tended to happen. And I sort of want to talk through some of the reasons why I think this is happening at the moment, because it does have a lot of similarities to what was happening in the late 90s and the early 2000s. So to take a step back, basically in 99, 2000, big tech boom, a tech bubble in the end, which burst, and it obviously did not work out very well for a lot of people. Basically what was happening is everyone thought that the internet was the future, and in a lot of ways it has been. I'm talking to you on the internet right now, and our lives would be completely different if it wasn't for the internet. But one of the things that you have to consider when you're buying into stocks with these sort of underlying theories is you still have to pay an appropriate price. And even if the internet is going to be the future, if you're investing in an internet-based business, that business still has to make money. And unfortunately, a lot of the stocks that were going public at that time and that were getting massive valuations on them were never likely to make that much money, if any. And if they were going to make money and be profitable, people were just paying way too much for them. We saw that a company like Yahoo peaked out at like a PE of 2000, I think it was, just enormous multiples. And we actually saw on the flip side that a lot of the more traditional stocks, even ones that had performed very well like Berkshire Hathaway, were hitting 52-week lows at the same time as the NASDAQ and all these tech stocks were peaking. And it sort of set up the conditions for these cheaper, more traditional value names to actually perform extremely well over the next 5 to 10 years. It's where we saw Berkshire Hathaway absolutely destroy the S&P 500 in those early 2000 years, because all these high flyers were just way too expensive and they could really only either be flat or come down over a sustained period of time. And we saw value stocks that were so cheap that they could only reasonably really go up. And so it set up the conditions for that type of thing to happen. And a lot of very famous value investors were sort of born out of that era. So it's where we discovered the David Einhorns and the Monis Pabrais, even the Bill Ackmans to a certain extent. It's where they got this massive outperformance because the conditions were so well set up for people that were really digging into underlying businesses and buying at discounts to intrinsic value to perform very, very well. Now, there's a couple of logical kind of follow-on questions that come out of this. Are we in the new 1999 or 2000 right now, and are similar things going to happen? I think from personal experience, we've got somewhat similar investor mindsets at this point. We see a lot of people getting pulled towards the tech stocks, the FANG stocks, the companies that have been growing really, really well. And a lot of them certainly deserve to have higher PEs and price to books than the traditional manufacturers and that sort of thing. I'm not disputing that for a minute. What I think we do need to look at a little bit more closely is whether those valuations are still stretched just a little bit too far. And for me personally, I'm seeing a lot of people that I interact with that are into investing tending towards these technology names and really not even taking the time to look at other businesses that are in more boring kind of traditional industries. And I think that's really one of the main reasons why we've seen such a wide spread at the moment.
And a really good example of that is a business right now, Microsoft. I'm sure you're all familiar with Microsoft, and it was one caught up in the early 2000 tech boom, but it was actually one where the business has done really, really well. And we're at a stage now where the business is phenomenal. It produces massive amounts of cash, great return on invested capital, well financed, well managed, a whole lot of great things going on with Microsoft. The issue is when you look at the price, it looks very, very expensive to me. So currently it's at something like a 2.5% free cash flow yield. So if you look at the price you're paying for the business at the moment versus the cash it's producing after doing all its capital expenditures, you're only getting about a 2.5% return in terms of cash flow on that business. Now, when you compare that to a more typical long-term return of maybe like 5 to 8 to 10% per year, it starts to look very, very expensive. And you get into a situation where even if Microsoft can grow really well into the future, let's say the business doubles, which for a company the size of Microsoft would be massive. For that company to double, you're now only at a 5% free cash flow yield, which isn't particularly high still, and the price has gone nowhere. You haven't actually made a return yet if you're at that 5% free cash flow yield, if the business has doubled and the price hasn't gone anywhere. And by the same token, with Microsoft, if the stock price were to drop 50% and the earnings remain the same, you're still going from that 2.5% free cash flow to 5% free cash flow. And even though the stock's down 50%, it really doesn't look particularly cheap. So I think that investors do need to be careful with the prices they're paying for these businesses. You can get into the trap of paying too much, and even if you get one of the best businesses on the face of the earth, it can still create quite poor investment returns. And on the flip side, you've got, again, these traditional businesses like Berkshire Hathaway, who have been beaten up in this recent kind of global craziness. So we've got Berkshire, which are one of the few companies that you can still get a pretty good proxy for intrinsic value by just looking at a certain book value multiple. Probably 1.2 to 1.3 times book value is roughly where I think intrinsic value is for Berkshire Hathaway. And currently Berkshire is trading at like 1.1 times book value. So in my opinion, they're at a modest discount to intrinsic value right now. That's not a signal to buy or a recommendation or anything like that. I'm just trying to prove a point that we're starting to get this spread between the high flyers and the traditional businesses that are still amazing businesses. We're getting a large spread in pricing between these two. You know, Berkshire as a company, I heard Toby Carlisle say this on his podcast last week, that Berkshire is cheaper than the S&P 500, it's growing faster than the S&P 500, and it's got a better capital allocator at the helm than the S&P 500, yet people are paying way more for the S&P versus what they're paying for Berkshire right now. So very interesting times. I think you could make a pretty darn good argument, as Cliff Asness has done here, that value stocks are likely to do very, very well over the next few years. Although I'm not a quantitative value investor looking at just single stats and these measures on companies, I'm trying to understand the business and buy it like a private owner would. It's still pretty interesting to keep an eye on. So that's an overview of the article. I found that very, very interesting. I hope you did as well, and I'm also keen to hear your thoughts on it if you're willing to share. So if you enjoyed the video, please hit like, hit subscribe, and I will see you in the next one. Cheers.